It's important to know the risk of a trade before you get in. One of the problems a lot of retail investors are getting into is that they'll see these furrows on Twitter say that this is the stock to get into. They'll be banging the table. But what will happen is these retail investors, they'll throw money at the wall, go balls to the wall. Only problem is they don't have an exit strategy. So a lot of people jump into AMC or GME or the short squeeze names, but they haven't the slightest idea how they're going to get out. So they just ride up to the top like a roller coaster, and they don't have any idea that maybe they should sell 2/3 of their position or at least half the position, cover the base amount that they put in now. They're still fully on the ride, and when it goes crashing back down, because eventually the stocks are going to have to come back to the exponential moving averages, the EMAs, especially if they break off on the daily and the weekly chart, eventually they're going to come back down. And if you see a gap on the daily chart, because you're going to look at the graph in the form of candles, not just the squiggly lines, the candles are representations of amount of time, and you see a gapping up, you know that sooner or later that gap needs to be filled, because the charts in trading stocks are almost always and almost exclusively representations of emotions. That's why when you hit resistance points that a stock has hit in the past, that's why it's going to serve as a resistance point in the future. And when it breaks out over that, then people are like, well, there's unlimited potential. I guess they better start buying in. And you see volume coming in, people buying more shares, and overall, excitement happens. So when you start changing the philosophy that you have towards looking at charts and scaling out of your position, like if you're up 10, 20, 30% on a position in a day, you best believe that boy's going to be coming back down. But if you take some profits, shave off 2/3, and you can get a lower overall cost average on your shares when you buy back on the dip. So that's my strategy, that's my thoughts, and I think you too could learn from this. And if you're not a stock trading person, at least know your risk with the things that you're doing. Is it a greater risk to sit still and stationary and not make a choice? Or is it a better risk reward if you actually go out there and allow yourself to be put out into the world? Because if you don't put yourself out there, then the risk is staying dormant, being stagnant in life. But if you put yourself out there, the worst that happens is what? Some people judge you, some people call you names, but ultimately we get to determine how we interpret the words of others, so that it doesn't have to dictate what happens to us, and we don't even have to worry about our self-image, because it's merely projections of themselves, and more often than not, when you start succeeding, then the judges and the critics will come out, because they will feel bitter that they did not follow their own passions or their own path. So tearing other people bent down, trying to be like magnets, dragging you down to their level is what they do. So those are the thoughts for today. A little bit of stock knowledge in there. Buy the dip, draw support and resistance lines. Important to do. Find that in your life. Support, resistance, and break out of the resistance so that you achieve new all-time highs in your life. They're not perfect analogies, okay? But they are analogies, so I'm going to stick with them. So thanks for tuning in. Toodles.